Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about one of the greatest threats to real estate, and it doesn't come from real estate or even have anything to do with real estate. The word bubble has been making headlines lately with an increasing number of pundits calling the level of investment in artificial intelligence a bubble. Well, last week, we learned about three different styles of investing: fundamentals, momentum, and arbitrage. On today's show, we're talking about the level to which a bubble has been created, and the discussion is centering around which pin is going to pop the balloon. The emphasis on the pin is misplaced in my view, and when you're in a bubble, I can tell you it feels good. I happen to know. I experienced the dot-com bubble. My company went public in February of 1999. We spent much of 1998 preparing for the public offering. There were some really great technology companies in those days that lost most of their valuation in the wake of the dot-com bubble bursting. Amazon lost 90% of its value. Nvidia lost 85% of its value. Intel lost 80% of its value. Microsoft 58%. Well, today, a third of the value of the S&P 500 is based on just 7 technology companies. If the market wakes up one day and realizes that these companies are overvalued, there will certainly be a correction. If the value of those 7 companies were to be similarly cut down as it was in the dot-com era, what would be the impact to the overall stock market? Let's just do a simple thought experiment. Let's say that these 7 stocks lose 80% of their value and that none of the other 493 companies in the S&P 500 lose any value at all. Now, if we see that happen, then the S&P 500 would effectively lose 27.2% of its value. And of course, the likelihood those other 493 companies would be unaffected is extremely low. So let's look at the value proposition for some of these companies to see if it's supported on a fundamentals basis. The problem is that the valuations are based on potential and that the incomes in these companies are based on investment, not the proceeds from operations. Now let's look at OpenAI, which is still private. They brought in about $2 billion in revenue in the last quarter. In that same period, they spent a little over $3.5 billion on inference expenses. This is mostly made up of electricity to power and cool the data centers. Now, I'm not sure how much of that $3.5 billion might have been made up of depreciation of the hardware infrastructure, but either way, the problem is that the business model is not yet profitable. There's probably a path to profitability, but who knows when. Now, we also need to put this into perspective. OpenAI is planning to spend ultimately $1 trillion building out its AI infrastructure. That's a big headline number. Problem is that the hardware has an incredibly short shelf life. If the investment's not earned back before the end of the equipment's useful life, then it was definitely a money-losing investment. Now, if we think about the previous technologies that transformed industry, let's go back to the railroad. If an investment in new rail infrastructure doesn't get used for 5 years, well, at the end of 5 years, you still have a railroad. But if a data center doesn't recover its investment in 5 years, that hardware is written off. Part of it is the result of about a 9% hardware failure rate per year. So at the end of 5 years, 45% of the hardware you installed in year 1 is now dead, and the rest is technically obsolete. Then layer on top of that the fact that Nvidia just made a $100 billion investment in OpenAI. That money is going to be used for OpenAI to in turn buy processing units from Nvidia. This is one of numerous so-called circular transactions that are happening in the industry. It's a little bit like my wife and I each writing a consulting contract with one another for $1 million. On paper, it looks like $2 million worth of value is created, but in truth, no tangible value was created. It's going to be interesting to see how the market values these circular transactions. The problem I'm seeing with the valuations is that they're based on potential. They're based on momentum, with lots of people pouring money into what has become a global arms race. And when I try to perform even the most simple back-of-the-envelope math, it's hard to make the numbers work. I mean, think about it. Does it make sense to you that one company, Nvidia, is worth more than the entire country of Japan? Intuitively, does it make sense? Well, if it does, then you should absolutely go out and buy more. But if this bubble pops, as I believe it will, what will be the collateral damage? Will the bubble splash? Will there be destruction of wealth, and will that wealth destruction cause a ripple effect throughout the rest of the economy? Will we see a reduction in consumer spending? Will people lose their jobs because of loss of equity? Will banks be negatively affected? Will a loss of stock market valuation result in withdrawal of bank deposits? Will that cascade into a reduction of credit available for consumers and for businesses? See, our world is incredibly interconnected with all kinds of counterparty risks that only become apparent when the counterparty can't perform. We saw this clearly in the wake of 2008. Now, in my mind, the signs of a bubble are as clear as day. I can't tell you what the pin will be that pops the bubble, or even when, for that matter. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.